Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are working on the Chapter 7 short exercises that were assigned in the digital study guide. So let me get my, all right, come on, page down. All right, there we go. All right, note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we finished off with problem 9 in the last video, so we're on 10 here. And get my pen. All right, there we go. All right, so it says here, Bright Smile Dental Group started 2014 with accounts receivable of $134,000 and a credit balance in the allowance for uncollectible accounts of $9,000. The following information relates to Bright Smile's operations: credit sales $322, collections on account $309, write-offs of uncollectible accounts $12.4. At December 31st, the aging of accounts receivable showed Bright Smile will probably not collect $7,300 of its accounts receivable. Okay, so notice that we're using, from this data, we know that we're using the allowance method because it's not telling us to write it off directly, and we're also using the allowance for uncollectible accounts. And if you notice here on D, the aging means we're using the aging method, right, in order to determine how much we're going to write off as part of the allowance method. They're not giving you all of the charts. They're not giving you the complete aging of the accounts receivables, but they are telling you that the total of the write-offs will be $7,300. Right, so it says here, journalize Bright Smile's transactions based on the information provided, and then prepare a T account of the allowance for uncollectible accounts to show your computation of bad debt expense for the year. And so let me draw a T account here, make a straighter line there. Okay, so this is my allowance account. And okay, so we're going to start out here and we're going to say we have to make journal entries. So I have credit sales, all right? So if I have credit sales of $322,000, all right, when we're making a journal entry that you can't find in the textbook, all right, you follow the procedure that I had posted in the couple of videos on how to make journal entries underneath the financial accounting section of the business group page. There's a couple of videos there on how to make journal entries, right? So we have credit sales here. First question I ask is, am I affecting cash? Well, no, I'm not affecting cash because they're credit sales. So 2 is, when I ask myself the second question, am I affecting accounts receivable or accounts payable? Okay, well, since it's credit sales, yes, I'm affecting accounts receivable, all right? So if I have credit sales and they're increasing because I start out at whatever dollar amount and I just make 322,000 more, okay? So I'm going to debit my accounts receivable for 322,000, and I'm crediting what? Debits have to equal credit, so I have to credit something else. Well, what am I doing? I'm making sales, so I will credit sales revenue for 322,000. Okay, so that's the journal entry for letter A. The only other thing that I might point out here is that instead of having an accounts receivable account, you might have a credit card receivable account, all right? Or something along that line. right? But that's something that would be unique to a specific business on their chart of accounts. You know, if I look at my accounts receivable, one of my accounts receivable just might be a credit card account. That would be, that would be one of my accounts in my accounts receivable. All right, so assume I might have, Amy Smith as an account. Then I'd have a credit card account, and let's say I have Tom Jones, right? So anytime I'm making a credit sale using a credit card, that would go into my accounts receivable underneath the credit card account, right? I just want you to be aware of that. That's something that you didn't see in the book, okay? And it's something that I just popped into my head right now, okay? So that's why I said you're not going to always find this stuff in the book. All right, so copy that journal entry down, pause the video if you have to, rewind it, right? Because I'm going to erase these journal entries as I make them. Okay, so what I want to do here is now I have a collections on account of 309,000. So if I have a collection on the account, right, again, one, am I affecting cash? And the answer to that is yes, because I'm collecting 309,000. So my cash is going up, so I'm going to debit my cash for 309. And I'm going to credit something else. Debits have to equal credit. So what am I going to credit? Well, I'm collecting on the account. Well, my on account is my accounts receivable. So I have 309,000. So that's the journal entry 4B. All right. Go ahead and pause the video if you have to. Okay, C, write-off of uncollectible accounts of $12,400. Okay, so what does that mean? All right, so number one, am I affecting cash? No, because I am, I'm not, I'm just not collecting cash. So, two, am I affecting accounts receivable or accounts payable? Well, yes, because I'm writing off an uncollectible account, meaning I'm writing off my accounts receivable. So my accounts receivable is going to decrease, right? So I'm going to credit my accounts receivable for $12,400. And of course I have to debit something else. Well, what am I debiting? I'm going to debit my allowance for uncollectible accounts, right? For the $12,400, right? And that's going to be my journal entry. Now, remember, when I originally did my calculation, which is what we're going to do in for this next journal entry, right? Remember, this is a cycle, okay? So I'm just going to give a date to this to give some kind of idea. This here is 2014. Well, in 2013, I might have gone through and aged my accounts receivable, and I would have made a journal entry to debit my bad debt expense and then credit my allowance account, right? That would have been on my books, and it would have given me a beginning balance here in my allowance for uncollectible accounts of $9,000, right? So it says here we're going to make a T account for the allowance to show our computation of the bad debt expense for the year. So in 2013, we made this calculation, which gave us a beginning balance. We made a calculation, and then we made the adjusting journal entry in order to write off, what we estimated to be our bad debt. That's what we're doing right here. That is what gives us this beginning balance of $9,000, which is in our allowance account. Now, remember, if you had watched the theory videos, I said this here is a running balance kind of thing, okay? You're always going to have, well, it's never going to be zero, and you always have to kind of back into certain information, and that's what we're doing here with this particular exercise. We're going to follow along how we know what the amount in our allowance for doubtful accounts should be. So we started out with this balance of $9,000. Yeah, we had credit sales. Yeah, we had collections. All right, on our credit sales, our accounts receivable. But now we're looking at our accounts. We're looking at our accounts themselves, and we're writing off this here additional $12,400. And when we post this journal entry to our account, we're going to have a debit of $12,400 in our allowance account. Now I'm going to erase this journal entry and work on D. All right. So on D at 12/31 of 2014, all right, it says the aging of accounts receivable showed that Bright Smile will probably not collect $7,300 of the accounts receivable. So go back to the theory videos under the aging method to watch how this $7,300 was arrived at. Okay, I'm not going to go back over that, but it is telling us that the amount on that we're estimating, it should be 7,300. All right. Now, what I'm about to do is what I would have done in order to arrive at this balance of $9,000, which again, I was saying would probably be, our calculation for the year 2013. All right. So if we do the aging and we say, oh, we should have in, we have an estimate of $7,300 of bad debt in our accounts receivable, well then our allowance account should have that $7,300 as a balance. Okay, and this is the balance for at the end of 2014. Okay, now how do we arrive at that $7,300? Well, we're going to back into the number or into the figure we need in order to make the correct adjustment. Well, if I have a credit of 9,000 and I need to have I have to end up with 7,300, right? And I have a debit of 12,400. Well, what I need to do is I need to take and add the 12,400 plus the 7,300, and then I'm going to subtract out the $9,000. Okay, and that gives me a balance of $10,700. So I have to make an adjustment for $10,700 to my allowance account. Right? All right. Do the math here. All right. If I have 9,000 plus 10,700, that's 19,700. This is a credit now, right? And if I have 12,400 as a debit, then the difference between the two is a credit of 7,300. Okay, and that's how I arrive at my credit balance here in the account, which is what I estimated it to be. All right. So let me just kind of like go back over that again, just to clarify it. Remember, the balance in the account is our debits less our credits. We want to have a balance of 7,300. Right, on the credit side. Now I can add my 9,000 and get 17,300, and then I subtract out the 12,400, and I end up with 10,700. I'm sorry, I keep on thinking 10,700. I end up with $7,300 is the amount that I'm going to make the adjustment for. I'm sorry, no, it is 10,700. I'm confusing myself here. All right, let me, Sorry about this. I'm thoroughly confusing myself. I did it right the first time, and I kept on thinking, why am I doing this? Yeah, getting this all wrong. All right, let me start all over again. Pay attention to this. All right, I need a balance of 7,300. All right, in order to get my credit balance, I have to add in the 12,400, which gives me $19,700. Then I subtract out the $9,000, which is my credit, which means I have to make an adjusting journal entry for the 10,700 in order to be able to get the balance we want of $7,300. Okay. All right. Sorry about that little bit of confusion. All right, but nobody's perfect. All right, so we know that we need to have an adjusting journal entry for 10,700, and of course that journal entry is a debit to the bad debt expense for 10,700 and a credit to the allowance for uncollectible accounts of 10,700. So that's the journal entry we're going to make to get the when we post this journal entry, that $10,700 ends up in our allowance account, and now that gives us the new balance of $7,300 that we want in the account. All right. So if we look at it on our in our ledger accounts or on our balance sheet, what we're going to have is we're going to have our accounts receivable at whatever amount that is, less our allowance, right, for uncollectible accounts of 7,300, and then that's going to give us our net accounts receivable of whatever amount that is. All right. So let me just toss in a number here. Let's call this I don't know, say 350,000, and that means I'd get 300 and let's see here, 3, 4, 7 to 27, $2,700 would be my net accounts receivable. I hope I did that math right. But anyway, the whole point behind this here is that we started out with a beginning balance of $9,000 in our allowance for uncollectible accounts, right? We estimated that $9,000. That's what gave us the beginning balance here for our allowance account. We would have made an entry in order to arrive at the $9,000 the same exact way we're making this entry for D, all right? Because this is the prior accounting period to get that balance. So once that happens, we have this balance at the beginning of our accounting period of $9,000 in our allowance account. Then our transactions occur. I mean, we have credit sales, we collect on our accounts receivable, we actually write off we actually write off the accounts receivable that we can't collect the money on, and that's when we make that journal entry, we're going to hit the allowance account right there with that amount, right? So when we get now, we do these transactions throughout the entire accounting period, but when we get to the end of the accounting period, we actually age our accounts receivable and arrive at a new balance saying, okay, based upon what our accounts receivable are right now at the end of this accounting period, I should have a balance of 7,300, right? But I have to make a journal entry in order to get to that 7,300. Well, how do I know how much that's going to be? Well, again, that's taking the 7,300, adding in the 12,400, then subtracting out the 9,000, and you end up with $10,700 as the amount you're going to make for the adjusting entry for that transaction in order to make sure that your allowance account is correct. Okay, so and again, that's just one. That is this is the way this account always works. It's always going to have this cycle. Okay, I call it a running balance, but maybe I should start calling it a cycle, where I, I do my estimate and that becomes my new beginning balance. Then things happen during the course of the month, and then at the end of the month, I have to calculate a new estimate and I back into my adjusting figure based upon how much I determine my estimate should be. But the point being is I'm backing into this adjusted, the amount for the adjusting entry. Okay. All right. So I hope you understood that. And if not, feel free to, go back and watch the theory videos again. And if you still don't understand it, feel free to contact an instructor. And I'll see you in the next video for the next problem.